Hello everyone. My name is Daita Kanodia and today we are going to have a discussion on co-lending. Co-lending is a financing model where two or more co-lenders collaborate to provide loans to the borrower. So co-lending will allow both the lenders to jointly advance a loan to the borrower. Now, let's have a look at the relationship between the lenders. In a co-lending arrangement, the relationship between the participating lenders, that is a bank or a NBFC or two NBFCs, is defined by a contract known as a intercreditor or a co-lender agreement. This agreement outlines the terms of cooperation, the roles and responsibilities of each lender, the risk sharing ratio, and other critical aspects of the partnership. While the relationship between the lenders is governed by the intercreditor agreement, the relationship between the co-lenders and the borrower is defined by a separate contract, which is the loan agreement. This agreement specifies the terms and conditions of the loan, including the repayment schedule, interest rates, and other obligations of the borrower. It ensures that, like in any lending arrangement, the borrower understands their commitments and the terms under which the loan is provided. So, to recapitulate a bit, the contract between the two co-lending partners is a intercreditor agreement or the co-lending agreement. The relationship between the co-lenders and the borrower is simply the loan agreement. Now, the legal nature of the relationship between the co-lenders is governed by the Indian Contracts Act 1872. This act provides the framework for all contractual relationships in India, ensuring that agreements are legally enforceable and that the rights and obligations of each party are clearly defined and protected. The Contract Act ensures that the intercreditor agreement is binding and that any disputes can be resolved within the legal framework. Now, a key feature of co-lending arrangements is the sharing of risks and rewards between the co-lenders. The risk sharing ratio, which is predefined in the intercreditor agreement, to recall, the intercreditor agreement is the agreement between the co-lenders, dictates how the risks are distributed between the lenders. Similarly, the rewards, such as the interest income and the fee, are also shared according to the ratio defined in the intercreditor or the co-lending agreement. Now, due to the differential roles of the co-lenders in the arrangement, the rates of return on the loans may be shared differently. For instance, one party might take on a larger portion of the loan and hence a larger share of the risk, while the other might handle customer facing aspects and thus a different portion of the returns. This differential sharing is crucial for aligning incentives and ensuring that both the parties are motivated enough to manage their respective roles effectively. Here, it is also crucial to understand that it is not necessary that the interest portion will be shared in the same ratio as that of the principal. For instance, the terms can be such that although the co-lending is in the ratio of 80:20, the interest is being shared in the ratio of 70:30. That is, although one co-lender is taking 80% of the risks, it is getting less than proportionate interest. This may happen because the other co-lender, that is the co-lender having 20% share, would be providing all the services to the borrowers, whereas the 80% partner is just the funding partner responsible for funding his 80% share. Now, purpose and types. The Reserve Bank of India has introduced the co-lending guidelines for priority sector. In the upcoming slides, we'll have a look at exactly what priority sector means and which all type of loans does it cover. So the RBI has included the co-lending guidelines for priority sector. primarily to improve credit access for underserved sectors. By combining the lower cost of funds from banks with the extensive reach of NBFCs, the ultimate beneficiaries, which are the borrowers, can access funds at more affordable rates. However, in our view, co-lending between two NBFCs should also adhere to these guidelines. Thus, co-lending can take place between a bank and a NBFC, between two banks, as well as between between two NBFCs. Economic rationale for co-lending. The co-lending model, as outlined by RBI, focuses on collaboration between banks and NBFCs. This model leverages the unique strengths of each institution. For instance, banks have access to cheaper funds, while NBFCs excel in customer relationships and niche market penetration. Again, by co-lending, NBFCs can offer loans at lower rates than they could independently, making funds more affordable for borrowers. Both the parties will share the risk and rewards, optimizing their resource allocation. Now, how does co-lending benefit the borrowers? So, borrowers have access to funds at lower rates than taking loans from NBFCs on a standalone basis. Expanded reach into underserved sectors uh, improves financial inclusion. Because of co-lending, NBFCs can provide customized solution to meet the borrower needs. Co-lending co-lending can take place for both priority sector and non-priority sector loans. On your screen, you can see the list which qualifies for priority sector lending. Although the RBI guidelines on co-lending are for the priority sector, we see no reason as to why in case of non-priority sector loans, the guidelines should not be adhered to. In the upcoming slide, we'll have an overview of the RBI guidelines on co-lending as well. Now, before doing that, let's understand what is discretionary and non-discretionary co-lending. Non-discretionary co-lending is where the co-lenders jointly originate the loan. That is, a bank or an NBFC or two NBFCs will jointly originate the loan, will jointly lend. In case of discretionary co-lending, however, one co-lender will have the discretion to approve or reject the loans originated by the other co-lender. That is, one co-lender, the funding co-lender, can cherry pick the loans and discard the rest. This is nothing but a transfer of exposure in the loans by the originating co-lender, and therefore the transfer of loan exposure directions of RBI should be adhered to. However, here it is important to understand that one co-lender can specify some predefined criteria for it to take the loans. In case the loans do not meet such criteria, the funding co-lender can reject the loans. This will, however, not be akin to discretionary co-lending. Now, let's have an overview of the RBI guidelines on co-lending. The first point is sharing of risks and rewards. The first point is minimum retention of 20% by the NBFC. So the RBI guidelines has prescribed that the NBFC has to retain at least 20% of the loans. It cannot transfer 100%, although a ratio of 100:0 is not a co-lending. So in case of non-priority sector loans and co-lending between two NBFCs should also adhere to this ratio of 20:80. This minimum retention ratio ensures that the originating co-lender has minimum skin in the game. Now, the guidelines also prescribe that co-lending arrangements with NBFCs cannot occur with an NBFC belonging to the promoter group. There has to be a co-lending agreement in place containing the features of the loans, the roles and responsibilities of each party. An all-inclusive interest rate agreed by both the lenders will have to be charged. That is, borrowers should not be asked to pay two different interests to two different co-lenders. An all-inclusive rate should be charged. Grievance redressal, both the co-lending partners will be responsible for addressing the grievances of the borrowers. Escrow account, the guidelines prescribe that the escrow account should be in place and all the collections from the borrower should happen through this escrow account. Therefore, the money will be first pooled into this escrow account and thereafter the money will be disbursed to the NBFC, to the co-lending partner, that is NBFC or a bank or two NBFCs in the agreed ratio. Recovery and security, both the co-lenders should be responsible for security, that is data privacy and security of the borrowers. Assignment of loan to third parties. Now, any assignment of loan to third parties, in our view, should happen with the concurrence of the other co-lender. Next, so we had an overview of the RBI guidelines. To summarize, co-lending is a collaborative model that combines the strength of both the co-lenders to provide better access to credit, share risks and rewards, and comply with the regulatory guidelines. It is playing a very crucial role in enhancing financial inclusion and transforming the credit landscape in India. So thank you for your attention. I hope this discussion has provided valuable insights into co-lending. If you have any questions, kindly drop them in the comment section.